Welcome to Griffonomics.
Glad to be here for this one.
So I want you to imagine, just for a second, that you are running a multi-billion-dollar company.
Right.
You've got over 400 million people using your main product every single day.
Which is huge.
Right, it's massive. You're pulling in billions in revenue.
Yeah.
By almost any historical measure, you've built an absolute empire.
Yeah, a total success story.
But then you wake up one morning to find this ruthless Wall Street hedge fund parading around a public presentation.
Oh, the worst nightmare for a CEO.
Exactly. And this presentation basically accuses you of setting $500 million on fire every single year.
It's just burning it.
Just burning it on a personal science fiction vanity project, and they are demanding you shut it down immediately, or else.
Yeah, that is not a hypothetical scenario at all today.
No, it is not.
Yeah.
Today we are doing a deep dive into the absolute chaos that is currently unfolding inside Snap Inc., the parent company of Snapchat.
It's honestly the ultimate corporate thriller playing out in real time. I mean, Snap has hit what everyone internally and analysts externally are calling its crucible moment.
A crucible moment. That sounds intense.
It is. We are watching a company violently attempting to transition away from that classic zero interest rate era of growth at all costs social media.
Right, the old Silicon Valley playbook.
Exactly. And they are trying to turn into this lean, fiercely disciplined, AI integrated computing hardware company.
Which is a massive pivot.
It's huge. And the transition is just leaving this trail of laid off engineers, enraged activist investors, and really massive strategic questions in its wake.
So to figure out what is actually happening behind closed doors here, we pulled together a stack of incredibly revealing sources.
Some really fascinating stuff in there.
Yeah, we're looking at exclusive interview transcripts with Snap CEO Evan Spiegel. And he really drops the corporate speak in these.
He gets surprisingly philosophical.
He does. He explains his deeply unorthodox philosophy.
Yeah.
We've also got internal memos detailing some brutal AI-driven mass layoffs.
Which we definitely need to get into later.
Oh, absolutely.
Yeah.
And providing the primary catalyst for all this drama, we have this blistering, incredibly detailed 6-step overhaul presentation from a special situations hedge fund called Irenic Capital Management.
Yeah, the activists are circling.
Right. So our mission for this deep dive is to synthesize all of this and answer one defining question.
Which is?
Is Snap merely a poorly managed software company throwing billions of shareholder dollars into an unproven hardware black hole?
Or
are they quietly and methodically building the exact proprietary technology that will inevitably render the smartphone obsolete?
It's a massive claim. I mean, kill the smartphone.
I know, it sounds crazy. But to even begin evaluating that, we have to start with this fundamental identity crisis at the heart of the company.
Right, the disconnect.
Exactly. We need to look at the massive chasm between what the founder believes his company is and what his own balance sheet says it actually is.
Yeah, and the philosophy of Evan Spiegel is arguably the single most important variable in this entire equation.
Because he doesn't sound like a normal tech CEO.
No, not at all. When you read his interviews, he's not talking like a standard software executive optimizing for ad clicks.
Right.
He talks extensively about being a disciple of Edwin Land.
The Polaroid guy.
Exactly, the brilliant founder of Polaroid.
Yeah.
Land had this operating thesis that true innovation only happens at the intersection of deep, complex technology and the liberal arts.
Which sounds great.
Yeah, it's a great quote. And Spiegel sees himself as the direct heir to that specific lineage.
Okay, hold on. Let's make that tangible for you listening. Because intersection of technology and liberal arts is a fantastic soundbite.
Sure.
But what does that actually mean when you sit down to build a real product?
Well, for Spiegel, it means designing technology that serves human sociology rather than forcing humans to adapt to the tech. He harbors this profound, almost philosophical objection to the modern smartphone. He genuinely believes that the screen, this glowing 6-inch rectangle that dictates our posture.
We're all hunched over all the time.
Right. He thinks it's an unnatural constraint on the human experience.
He really hates phones.
He does. He argues that the way computers have been engineered over the last 50 years is literally pulling us away from our physical reality. It isolates us.
He actually paints this incredibly vivid, kind of funny picture in the sources.
Oh, the alien thing.
Yeah, the alien thing. He talks about hypothetical aliens looking down at Earth and concluding that human beings have been entirely enslaved by these little glowing rectangles. Mm-hmm. We walk with our heads down. We ignore the people sitting across the table from us.
It's a slightly ridiculous image, sure.
But reading his words, you realize he takes this existential threat incredibly seriously.
Oh, he takes it so seriously that it entirely dictates his corporate strategy, like completely. Because of this philosophy, Spiegel fundamentally does not view Snap as a messaging app.
Wait.
He does not view it as a social media platform either.
Even though that's what everyone uses it for.
Exactly. He explicitly stated that he views Snap's entire $7 billion software business, the app you use, the vanishing photos, the massive ad infrastructure, merely as a funding vehicle.
A funding vehicle. Okay, I need to stop you there because my jaw honestly dropped when I read that in the notes.
It's wild, right?
It is. He is sitting on a publicly traded social network used by hundreds of millions of people, and he is treating it like his own private venture capital slush fund for sci-fi glasses.
Well, I mean, his critics would absolutely use the term slush fund.
I bet they do.
But his logic is that inventing the next paradigm of human computing, which he firmly believes is lightweight, immersive, augmented reality.
Stuff that overlays the digital world onto the physical one.
Exactly. He says that requires a decade of research and billions of dollars in capital.
Nobody wants to fund that.
Yeah, right. No traditional VC firm on Earth is going to fund a 12-year hardware development cycle with zero short-term return.
Makes sense.
So his only path forward was to fund it himself by siphoning the massive cash flows generated by the Snapchat app.
Wow. It's just a staggering level of ambition.
It really is.
But, if your entire plan relies on treating your software as a cash-generating engine to fund the future, we have to look under the hood of that engine.
And it's not looking great under there.
No, according to the financials, that core advertising business is struggling.
Yeah, severely.
They're reporting a very anemic 6% year-over-year growth.
Which in tech is basically flatlining.
Exactly. They are facing pricing pressures, a 10% decline in cost per impression, and an onslaught of privacy regulations.
Right. From Apple and the EU, the engine is definitely sputtering.
It's sputtering relative to the hypergrowth we saw a few years ago. But there is a massive, unexpected bright spot in their revenue mix.
Oh, yeah. We have to talk about that before we write off their software entirely.
Right. The direct-to-consumer revenue. Specifically, the phenomenal rise of Snapchat Plus.
The subscription lifeboat.
Yes, the lifeboat. And I want you, the listener, to think about your own digital habits for a second.
Yeah, consider this.
Would you pull out your credit card and pay $4.99 a month for a social media app that is otherwise completely free?
Most people over 30 would say absolutely not.
Right, because the numbers here just defy traditional tech logic. Snapchat Plus has exploded to 25 million paying subscribers.
It's incredible.
They're generating a $1 billion annual recurring revenue, or ARR, run rate.
$1 billion.
And that number is compounding at 60% year over year.
Which is just a monumental business feat. Achieving $1 billion in ARR from a subscription tier bolted onto a free app.
It's unheard of.
It now represents roughly 13% of Snap's total revenue. But I want to turn your question around for a second.
Okay, go ahead.
What are these 25 million users actually buying? Because unlike YouTube Premium or Spotify, they are not paying to remove ads at that basic tier.
That is the most fascinating part of this whole thing. They are paying for digital status.
Digital status?
Yeah. They get custom app icons, they get exclusive wallpapers for their chat screens, they get to pin one friend as their absolute #1 BFF with a special badge.
A BFF badge.
And they get to see who rewatched their stories.
Which, I mean, sounds completely trivial to a 45-year-old financial analyst on Wall Street.
Oh, entirely trivial.
Yeah.
But for Gen Z, your Snapchat profile is basically your digital living room.
That's a great way to put it.
It's where you hang out. Paying $5 a month to customize the furniture in the room where you spend 3 hours a day makes complete psychological sense to them.
It totally does. And from a macroeconomic perspective, this high-margin revenue is just a brilliant strategic lifeboat.
It's a pure software margin.
Exactly. Subscriptions carry exponentially higher margins than ad sales. And more importantly, this revenue is completely insulated from ad market volatility.
Right, and external privacy regulations.
Yeah, when Apple rolls out a new iOS update that makes it impossible to track user data for targeted ads.
Which they did.
That $1 billion in subscription revenue doesn't even blink. It's totally safe.
And they're expanding it too. Snap recently launched memory storage plans, allowing users to pay for cloud backup of their old photos.
That is such a smart flip.
Right. They took a massive server cost center, storing petabytes of user data, and flipped it into a revenue driver.
Okay, so the subscription business is a triumph.
It is.
But a lifeboat implies that the main ship is taking on water.
Good point.
If the core software is supposed to be the funding vehicle for Spiegel's hardware dreams, we really have to understand why the advertising side of Snap is getting crushed by its rivals.
To understand that, we have to dive into the harsh structural reality of Snap's monetization model.
Let's get into the numbers.
It all boils down to one critical metric, ARPDAU. That's average revenue per daily active user.
For those outside the digital marketing bubble, that is literally just a measure of how much money a company extracts from you, the individual user, every single day you open the app.
Right, and Snap's ARPDAU is currently trapped beneath a ceiling of roughly $13.
$13.
To understand how weak that is, we have to look at the broader market. TikTok is currently extracting about $33 per user.
So more than double.
And Meta, meaning Facebook and Instagram, is sitting at a staggering $57 per user.
Wow.
Meta is mathematically more than 4 times better at monetizing a human being than Snap is.
And that gap, honestly, it makes no intuitive sense at first glance.
Why not?
Because Snap has nearly 1 billion monthly active users. They have 474 million daily active users.
It's massive scale.
And in regions like the US and the UK, they reach 75% of all 13 to 34-year-olds.
Which is the golden demographic.
Exactly. Advertisers historically salivate over that specific young demographic. So why can't Snap sell ads against them efficiently?
Well, the sources show it is not a failure of their sales team.
No.
It is a fundamental structural flaw in the product itself. Industry analysts call it the intent data deficit.
The intent data deficit. Okay,
Break that down.
Snap built its entire empire on the premise of ephemeral messaging.
Yeah, photos and videos that disappear.
They disappear immediately after they are viewed, sent privately between small groups of friends.
Which, from a human privacy standpoint, is incredible.
It's fantastic. But from the perspective of an algorithmic advertising engine, it is an absolute nightmare.
Why?
We have to trace the history of digital ads to see why. 20 years ago, Google invented the modern ad business by capturing search intent.
Right, typing into a box.
If you type buy size 10 running shoes into Google, you are demonstrating massive commercial intent. You are literally telling the algorithm exactly what you want to purchase.
And then Meta came along and pioneered behavioral intent.
You might not search for running shoes, but if you linger for 4 seconds on an Instagram video of a marathon runner, Meta's algorithm infers your intent.
And then floods your feed with shoe ads.
Exactly. But Snap's ephemeral architecture breaks both of those models.
Because everything disappears.
Right. When you send a disappearing selfie with a silly dog ear filter to your best friend, you are generating 0 commercial intent data.
The algorithm learns nothing about your purchasing desires.
Nothing. There is no historical feed to scroll, no persistent data trail to analyze. The AI has absolutely nothing to optimize its ad targeting against.
Let me build on an analogy here, because I think it perfectly captures the dilemma for anyone trying to wrap their head around this.
Go for it.
Trying to sell ads on Snapchat is like trying to sell high-end billboard space in a town where the citizens only communicate by whispering secrets into each other's ears.
Oh, I like that.
And then they immediately forget what was said.
Mm-hmm.
So the advertiser is standing in the town square with a giant net, trying to catch whispers to figure out what people want to buy.
And they just can't.
I just can't.
That town of whispers analogy is spot on, but we have to add one more layer to it to truly understand the financial pain here.
Okay, what's the layer?
Think about the infrastructure costs required to run that town. Snap is processing 5 billion of these snaps every single day.
5 billion a day.
And these are mostly high-definition videos and heavy image files.
That's a lot of data.
The cloud computing power, the server space, the bandwidth required to process, route, and instantly delete 5 billion videos daily is astronomically expensive.
So they are getting hit from both sides.
Exactly.
They have an intense gross margin pressure. They are paying exorbitant infrastructure costs to facilitate a private, peer-to-peer video messaging utility.
Right.
But because of the lack of intent data, they are struggling to monetize that utility at a rate that covers a server bill.
It is a profound structural flaw. They built a private communication utility, but they went public and promised Wall Street that can monetize it like a public broadcasting network.
And you can't.
You can't. And this massive gap, the distance between Snap's undeniable cultural relevance and its deeply flawed financial mechanics, it bloodied the water.
And when there is blood in the water on Wall Street, the sharks arrive.
They absolutely do.
Which brings us to the activist siege.
Here we go.
In March 2026, a special situations hedge fund named Irenic Capital Management, which had accumulated roughly a 2.5% economic stake in Snap, decided they had seen enough.
They wanted changes.
They launched a highly public, incredibly aggressive activist campaign. They published a presentation titled Snap Back to Reality.
Catchy title. Let's define what a special situations fund actually is for the listener.
Yeah, please.
They don't just buy a stock and wait for it to go up. They look for companies that have incredible underlying assets but are being mismanaged.
In their opinion, at least.
Right. They buy enough stock to get a seat at the table, and then they publicly bully management into restructuring the company to unlock that trapped value.
And Irenic's presentation did exactly that.
It was brutal.
They laid out a ruthless six-step plan. They modeled that if Snap's board forced Evan Spiegel to implement these specific steps, the share price would jump from its depressed level of around $3.93 all the way up to $26.37.
That is a 7x return. They are claiming they can unlock $35 billion in dormant shareholder value.
Let's do some forensics on their specific grievances, because the numbers they highlight in this report are frankly hard to believe.
Yeah, let's start with their biggest target, dilution and stock-based compensation, or SBC.
Right, SBC.
Stock-based compensation is the lifeblood of Silicon Valley. Instead of paying an engineer $300,000 in cash, you pay them $150,000 in cash and $150,000 in company stock.
Right. It saves the company cash up front.
And theoretically aligns the employee with the company's success. But to give that stock, the company has to print new shares.
And when you print new shares, you make every existing share slightly less valuable. You are slicing the ownership pie into smaller and smaller pieces. It dilutes the existing shareholders.
And Irenic points out that Snap has abused this mechanism to an unprecedented degree. Since going public, Snap has issued over $8 billion in stock-based compensation.
$8 billion. I really want everyone to stop and think about that number. $8 billion in stock given away to employees.
It's wild.
The entire market capitalization of Snap today, what the open market says the whole company is worth, is only $6.6 billion.
Unbelievable.
Over the company's public lifespan, management has literally handed out more value to its staff than the entire company is currently worth today.
The math is staggering. Irenic's data shows this has resulted in a 70% dilution of public shareholders since the IPO.
70%.
If you bought 1% of Snap at the IPO and just held it, your voting power and economic claim would have been mathematically slashed by 70% just from management printing shares for employees.
That is just...
In 2025 alone, Snap granted 175 million restricted stock units. They basically gave away 10% of the entire company in a single calendar year.
And Irenic highlights that Snap's SBC per employee is 67% higher than the average of its tech peers.
Way above average.
While companies like Uber, Spotify, and Pinterest use the post-COVID downturn to rationalize their hiring and cut compensation bloat, Snap just kept printing shares.
We didn't stop.
Irenic argues that Snap's reported adjusted EBITDA profitability is a complete illusion because management casually excludes this massive stock expense from their profit calculations.
So Irenic's demand here is very practical. They want Snap to stop treating company equity like monopoly money.
Fair enough.
They are demanding a shift from purely time-based vesting, where an employee gets stock simply for not getting fired for a year, to performance-based vesting.
Tie it to the actual business.
Exactly. They want employee stock grants tied directly to the share price, hitting $10 and $15 targets. If the shareholders don't make money, the employees don't get the stock.
That sounds like basic financial discipline.
It does.
But it begs a massive question. If management has been diluting the stock by 70% and burning billions of dollars on R&D, why haven't the shareholders simply voted to fire the CEO?
Because they can't.
Wait, what?
They literally can't. And this brings us to the core governance issue that Irenic is attacking. Snap operates under a highly controversial three-class share structure.
Oh, this is the voting rights thing.
Right. The shares that you or I or Irenic Capital can buy on the open public market are Class A shares. Those Class A shares represent 85% of the total economic value of the company.
Boy.
But they carry exactly 0% of the voting rights.
This is a concept that I think outside observers just struggle to comprehend.
It's very unique.
If I go onto my brokerage app and buy a share of Snap, I am providing the capital. I am taking 100% of the financial risk if the stock goes to zero. But I have literally zero say in how the company's operated. I cannot vote for board members. I cannot vote on executive compensation. I cannot vote to stop the CEO from spending $3 billion on glasses.
Nothing.
Why on earth would any institutional investor agree to those terms?
It was a power dynamic established during the easy money tech boom of the 2010s, you know?
Right, when founders were gods.
Exactly. Founders like Mark Zuckerberg at Meta and Lori Page at Google popularized dual-class structures to maintain control. But Evan Spiegel took it to its absolute authoritarian limit by offering a class of stock with 0 votes.
0.
The philosophical justification from the founders is that the public markets are obsessed with 90-day quarterly earnings. If you want to build a company that invents a 12-year hardware cycle, you have to insulate yourself from Wall Street's short-term demands.
But Irenic argues that absolute insulation just leads to absolute lack of accountability.
Precisely.
You get bloated compensation and massive R&D burn because no one can stop you. So what is the activist hedge fund actually demanding regarding the voting structure?
They are demanding that Snap immediately amend its charter to give every Class A share 1 vote.
But wait, let's look at the math again. The founders, Evan Spiegel and Boggy Murphy, hold Class C supervoting shares.
Yes, they do.
Even if the public gets 1 vote per share, wouldn't the founders still hold something like 64% of the total voting power?
Yep. They would still have total control.
They would still be corporate dictators. What is the actual point of Irenic fighting for 1 vote if it doesn't change who is in charge?
I'm really glad you asked that because this is where we get into the hidden plumbing of the financial markets.
The plumbing.
Yeah. Irenic doesn't actually care about winning a boardroom vote. They know they can't.
Then what do they want?
They care about index inclusion.
Oh, explain the mechanics of that.
Right now, massive financial indices like the S&P 500 or the Russell US indices have strict governance rules. They outright refuse to include companies whose public shares have 0 voting rights.
Ah, okay.
Therefore, Snap is excluded from these massive benchmarks.
I see.
If Snap gives the public just 1 vote per share, they suddenly meet the minimum governance requirements. They become eligible for index inclusion.
And when you're in the index.
When a company is added to a major index, every single passive ETF and index fund in the world that tracks that benchmark is algorithmically forced to buy the stock.
Forced to buy it.
It doesn't matter if they like the company or hate the company. Their mandate requires them to buy it to match the index weight.
So Irenic isn't fighting for democracy.
Not at all.
They're fighting to flip a mechanical switch that will force billions of dollars of blind algorithmic buying pressure into the stock, which they estimate will trigger a massive multiple re-rating and drive the share price up.
Exactly.
That is incredibly clever Wall Street engineering.
It is. Very tactical. But Evan Spiegel and the board couldn't just ignore this incredibly public, highly sophisticated attack.
They had to do something.
The combination of Irenic's demands, the stalled ad revenue, and the internal cash burn meant the status quo was mathematically unsustainable. Management was forced to react.
Which brings us to a massive strategic inflection point. The AI restructure.
Yes.
You can see the panic, or at least the realization, in management's investor presentations over the last year. The language abruptly shifted from the old Silicon Valley mantra of growth at all costs to a sudden, desperate focus on profitable growth.
Yeah, that's a huge shift in tone.
Then we saw the first real proof of this pivot in the 4th quarter of 2025.
Yes. Q4 2025 was a landmark moment for them. It was Snap's first genuinely profitable quarter.
Finally.
They posted $45 million in net income and generated $437 million in free cash flow for the entire year.
But the mechanism they used to achieve that profitability is completely counterintuitive to everything we know about social media.
Right, they fired their own users.
They literally reported a quarter-over-quarter decline of 3 million daily active users.
Which is wild.
Now, historically in the social media business, user growth is the holy grail. It is the only metric that matters. If your user base shrinks, Wall Street punishes your stock immediately.
Usually, yes.
How does deliberately shedding 3 million users lead to record profitability?
It brings us back to the unit economics of cloud computing. Remember the massive server costs we discussed earlier?
The 5 billion videos a day?
Processing high-definition video for hundreds of millions of people is incredibly expensive. Let's say you have a user in a developing market where digital ad rates are pennies on the dollar.
Right.
Or you have a user who sends 100 videos a day to their friends but aggressively scrolls past every single ad.
That user is generating negative margin.
Exactly. They cost more in server electricity and bandwidth to host than they will ever generate in ad revenue. For years, Snap subsidized those unprofitable users just to inflate their top-line growth numbers for investors.
Chasing the vanity metrics.
But under the pressure of the activist siege, they stopped. They deliberately recalibrated their infrastructure, stopped subsidizing high-cost, low-revenue regions, and allowed those 3 million unprofitable users to fall off the platform.
Just let them go.
By shrinking the network, they drastically improved the profit margin of the remaining users.
It's a painful but necessary shift from vanity metrics to actual unit economics.
Yeah.
But shedding users alone wasn't enough to appease the activists or fix the balance sheet.
Not even close.
In April 2026, Snap management executed what internal memos refer to as the Crucible moment. They initiated a massive reduction in force, slashing 16% of their global workforce.
That equates to roughly 1,000 employees losing their jobs overnight.
1,000 people.
This follows previous rounds of cuts, and it was explicitly designed to strip $500 million out of their annual cost base by the second half of 2026.
And this perfectly aligned with Irenic Capital's specific demand to execute a 1,000-person layoff to fix the bloated cost structure.
Right. But layoffs in tech aren't new. The rationale that CEO Evan Spiegel provided in his internal memo to the staff is what makes this a truly landmark moment in corporate history.
Yeah, he didn't use the usual buzzwords.
He didn't use the standard CEO boilerplate about macroeconomic headwinds or restructuring for synergies. He explicitly pointed the finger at artificial intelligence.
Which is just crazy to read in an official memo.
He stated very clearly that rapid advancements in internal AI tools had enabled their engineering teams to drastically reduce repetitive work and dramatically increase their coding velocity.
AI is doing the work.
He revealed that under Snap's new operating model, a staggering 65% of all new code being committed at Snap was now being autonomously generated by AI.
65%.
Furthermore, 67% of all customer support inquiries were being handled entirely by automated AI agents without human intervention.
I really want you, the listener, to stop and internalize what that means for a second. Think about your own job, your own industry.
It's profound.
A major publicly traded tech company just eliminated 1,000 highly paid, highly skilled jobs overnight. Not because the business was failing, but because AI algorithms are now writing the software code and handling the customers. If AI can trigger a 16% workforce reduction in a pure tech company today, how is this technology going to restructure your specific industry in the next 18 months? Are you prepared for the efficiency miracle that is also an existential threat to white-collar labor?
It is the defining economic question of this decade.
It really is.
But from Evan Spiegel's perspective, this AI efficiency isn't just a cost-cutting tool. It is the ultimate strategic equalizer.
Equalizer against who?
For 15 years, Snap has been locked in trench warfare against trillion-dollar monopolies like Meta and Google.
Right.
Those companies have effectively infinite engineering resources. Whenever Snap invents a brilliant new feature, like when they invented the concept of vanishing stories, Meta just unleashes an army of 10,000 engineers to clone it into Instagram.
Right, they can just outmuscle Snap with sheer human capital.
Exactly. But now, with AI acting as a massive force multiplier, Spiegel believes that dynamic has fundamentally shifted.
How so?
He argues that a small, hyper-talented squad of 5 engineers at Snap, armed with advanced AI code generation tools, can now match the output and velocity of a massive 500-person engineering department at Meta.
AI levels the playing field against the monopolies.
That's his thesis.
I hear that argument, but I have to push back hard on the logic here.
Okay, let's hear it.
If AI is now successfully writing 65% of the core code for the Snapchat app, are we still investing in a fundamentally unique, highly defensible software company? Or are we just investing in a very efficient AI wrapper? If an off-the-shelf LLM can write the code for Snapchat, what stops 4 kids in a dorm room from using that exact same AI to write the code for a Snapchat competitor over the weekend?
You have just articulated the exact existential terror that struck Evan Spiegel over a decade ago.
The fear of being cloned.
It's the realization that software has no moat. AI is simply pouring gasoline on the commoditization of software.
Because the code itself is easy to write now.
Exactly. If anyone can use a prompt to generate a functioning social network, then the code itself offers zero competitive advantage.
So it's a moat.
The only remaining moats in the digital world are network effects, the sheer inertia of the fact that all your friends are already on Snap and don't want to leave, and proprietary data.
Which, to be fair, Snap has in spades.
They have so much data.
They are sitting on over 1 trillion saved user memories, 5 billion daily visual interactions, and 17 billion engagements with their generative AI camera lenses.
It's a gold mine.
Activist investors have loudly pointed out that this visual dataset is incredibly valuable. Snap could license this data to OpenAI or Google to train their next-generation video models for billions of dollars in pure profit.
They absolutely could. It's a huge asset. But Spiegel's ultimate answer to the software has no moat problem isn't to become a data merchant.
No.
His ultimate answer is to escape the software trap entirely by owning the physical hardware.
Which finally brings us to the most controversial, heavily debated aspect of Snap's entire business model.
The main event.
The absolute centerpiece of the activist battle. The AR specs gamble.
All glasses.
Let's lay out the brutal financial reality of this gamble. Snap just fired 1,000 human beings, causing immense disruption and pain to their workforce to save $500 million a year in operating costs.
Right.
But Irenic Capital's forensic accounting points out that Snap is actively burning an estimated $500 million every single year on one highly secretive, unproven research project.
Spectacles. Snap's augmented reality smart glasses division.
Yep.
According to the Irenic presentation, Snap has poured an unbelievable $3.5 billion into this specific R&D project over the past 11 years.
Wait, 3.5 billion.
Yeah, $3.5 billion. And despite over a decade of labor and billions in capital, they still do not have a viable mass-market consumer product that you or I can go buy at Best Buy.
$3.5 billion. If you are an institutional investor looking at a company with a total market cap of $6.6 billion,
Yeah.
and you realize that management is quietly setting 35% of their pre-specs operating profit on fire in a secret hardware lab,
It is infuriating for them.
it feels like absolute financial malpractice.
Which is why Irenic Capital is completely uncompromising on this issue. Step 1 of their 6-step turnaround plan is aggressively titled Spin or Shut Specs.
Spin or shut?
They make the very rational argument that the public equity markets are fundamentally the wrong vehicle for funding highly speculative, decade-long venture capital bets.
Leave that to the VCs.
Exactly. They are demanding that Snap either spin the Spectacles division out into a separate private entity funded by external VC money, or take a sledgehammer to the lab and shut it down immediately.
And the financial incentive they attach to this demand is massive. Irenic's models indicate that this action alone, just turning off the $500 million annual cash incinerator, would instantly trigger a 52% upside to the stock price.
On a spreadsheet, it is the easiest, most obvious win imaginable.
Just cut the cord.
But Evan Spiegel absolutely refuses to yield. He won't shut it down. And when you read his interviews, when you truly understand his history, you start to see why he is so incredibly stubborn about this.
It goes back to that 2012 trauma, doesn't it?
Yeah.
When Facebook blatantly cloned the story's feature.
Exactly. That moment broke Spiegel's trust in the software ecosystem. He had the agonizing epiphany that if your entire company exists purely as software running on someone else's hardware, specifically Apple's iPhone or Google's Android, you are forever at their mercy.
You are a digital sharecropper.
Exactly. And Apple proved this thesis perfectly a few years later when they unilaterally changed the iOS privacy settings and wiped out tens of billions of dollars in social media advertising revenue overnight.
With one software update.
Spiegel realized that to survive long-term against these trillion-dollar platforms, Snap must become the platform. They must own the hardware.
He wants to reinvent the fundamental concept of the computer. He wants to build the glasses that finally free humanity from staring down at the smartphone screen.
Which is incredibly romantic.
It is. But look at how he is executing this vision compared to his biggest rival. Let's analyze Meta's playbook for smart glasses.
Meta took a highly pragmatic, partnership-driven approach.
Mark Zuckerberg realized that building a new face computer is incredibly hard.
It is. So he partnered with Luxottica, the massive Italian conglomerate that owns Ray-Ban. Meta took their cameras and AI chips and hid them inside the iconic, stylish Ray-Ban Wayfarer frames that millions of people already wear and love.
It was a brilliant, low-friction go-to-market strategy.
It bypassed the nerd factor and drove rapid consumer adoption.
But Snap is doing the exact opposite.
Yeah, they are.
They are taking what I would call the grueling Apple approach or the early Tesla approach. They aren't partnering with a fashion brand. They are attempting to build every single piece of the hardware and software stack stack completely from scratch in-house.
Yes, they are relentlessly pursuing vertical integration. Spiegel believes that if you just slap a camera on a pair of Ray-Bans, you aren't innovating. You are just making a fun Bluetooth accessory. To build true augmented reality, the ability to project high-fidelity 3D digital objects seamlessly into the physical environment, you have to engineer the foundational optics yourself.
Explain the hardware challenge there. I see the term complex waveguides thrown around in these tech specs. What does that actually mean for the product?
This is the bleeding edge of physics. A waveguide is essentially a microscopic piece of precisely etched glass.
Okay.
Its job is to take the light emitted from a tiny microdisplay hidden in the arm of the glasses, bounce that light through the lens, and project it directly into your pupil so that a digital image appears to exist in the real world.
That sounds ridiculously difficult.
Doing this without bulky lenses, managing the intense heat generated by the processor so you don't burn the user's face, and maintaining a wide field of view is literally one of the hardest engineering challenges in human history.
And Snap is trying to engineer those waveguides, design the silicon, and write a bespoke operating system, Snap OS, from the ground up.
All of it.
It's like Snap is trying to forge their own internal combustion engine from raw iron ore in a garage, while Meta just walked into a dealership, bought a Ferrari, and slapped their logo on the hood.
That's a brutal comparison.
Is Spiegel's approach visionary? Or is it just a recipe for bankruptcy? Because Wall Street clearly hates the garage approach.
Wall Street hates it because it completely breaks the predictable, high-margin financial model of a software business.
Right.
But Spiegel argues that true paradigm-shifting innovation, like the original Apple Macintosh or the iPhone, requires owning the core foundational technologies.
They can't outsource the magic.
Exactly. He wants to target a small group of passionate early adopters with a premium, vertically integrated product and then ride the manufacturing cost curve down over a decade. He argues that keeping Snap independent and using the app's ad revenue to fund this was the only way this technology could ever be birthed into existence.
Which brings us to the profound market skepticism and the massive external risks surrounding this company.
Because the risks are everywhere.
If Snap is betting the entire future of the enterprise and burning billions of dollars on a highly anticipated 2026 hardware launch of these spectacles, what happens if they stumble at the finish line?
Financial analysts refer to this setup as a binary bet. It is a multi-billion-dollar coin flip.
Let's look at the bullish outcome first.
Okay. If the 2026 specs achieve mass consumer adoption and their massive base of 450,000 developers who are already building AR lenses for the phone translates into a thriving, vibrant app ecosystem on the glasses,
Then Snap pulls off the impossible.
yes, they leapfrog the smartphone entirely. They transition from being a struggling messaging app to being the foundational hardware and operating system monopoly of the next computing decade.
But what if they flip tails? What if the 2026 launch arrives and consumers look at the glasses and say, these are too bulky, the battery dies in 40 minutes, the interface is clunky, and honestly, my iPhone works just fine?
In that scenario, the $3.5 billion investment and all the future billions they have committed to spending instantly becomes what accountants call a stranded asset.
Worthless.
It becomes worthless, obsolete technology that actively bankrupted the core software business while management was distracted.
And it's not just the hardware execution risk keeping investors awake. There are intense, immediate external headwinds battering the core software business while they desperately try to finish these glasses.
Yes, we have to look at the tightening regulatory environment.
The big factor.
Snap, along with Meta and TikTok, is facing unprecedented global scrutiny regarding child safety, mental health, and stringent age verification laws.
Right.
For example, recent regulatory compliance pushes resulted in Snap having to purge over 400,000 user accounts in Australia alone.
Just wipe them out. Now, maintaining our strict impartiality regarding the politics of these regulations, the factual business impact is undeniable.
It is. Aggressive compliance and age verification purges actively and permanently reduce the daily active user count. And as we established earlier, fewer users means lower advertising reach and lower revenue.
It is a constant, suffocating downward pressure on their core growth metrics. And then we have to look at the risks surrounding their highly touted AI partnerships.
Because that hasn't gone smoothly either.
Not at all. Earlier in the sources, management bragged about how successful their My AI chatbot was, reaching 100 million users in a single month.
Which sounds great on paper.
It's powered by a mix of OpenAI and Google Gemini models. But the actual monetization of that AI usage has been heavily criticized by the activists.
Irenic's presentation points out massive structural flaws in how Snap is trying to make money off these AI tools.
The Bing integration, right?
Yeah. To monetize the My AI chatbot, Snap signed a partnership to integrate sponsored links for Microsoft Bing. But Irenic argues this is a catastrophic demographic mismatch.
How so?
Bing's advertiser base skews heavily towards 45-plus desktop users searching for mortgages and enterprise software.
And Snap's audience is mobile-first teenagers and 20-somethings.
Exactly. Unsurprisingly, serving Bing ads to Gen Z has generated negligible disclosed revenue.
Irenic also highlights a massive, highly embarrassing failure regarding a partnership with Perplexity AI.
Oh, this one is rough.
Snap was supposed to integrate Perplexity's engine for live conversational search, and the deal was reportedly valued at roughly $400 million starting in 2026.
A huge deal.
But according to Irenic's notes, the partnership was abruptly paused because the integration was producing unreliable, low-quality AI slop that was actively degrading the premium feel of Snap's brand.
AI slop. It just proves that you can't just bolt an LLM onto your app and expect it to magically print money.
So to summarize the risk profile for you listening, you have a company trying to invent the most complex hardware future imaginable, while their core advertising engine struggles with a fatal intent data deficit, their regulatory environment tightens globally, and their AI monetization partners stumble.
It is an incredibly precarious high-wire balancing act.
Which brings us to the final verdict, the ultimate value unlock.
Time to bring it all together.
We have spent the last hour weaving all these complex threads together. The visionary, obstinate founder, the brutal activist demands, the AI-driven layoffs, the multi-billion-dollar hardware gamble. So for anyone analyzing Snap today, what is the definitive conclusion?
When you strip away the drama and synthesize the pure financial reality, Snap is currently trading at a severe, unprecedented discount to its tech peers.
Really low multiples.
It is currently valued at roughly 1.2 to 1.4 times its annual revenue.
Let's contextualize that. Meta is trading at, what, over 5.2 times revenue?
Exactly. Even Pinterest is trading at over 2.0 times. Snap is being priced by the market as if it were a distressed asset headed for bankruptcy.
But it's not.
No. But as we established, this is a company with nearly 1 billion monthly active users, an absolute stranglehold on the highly coveted 13 to 34 demographic, and a rapidly expanding subscription business generating $1 billion in ARR.
Hold on. Earlier, you used a specific term to describe this setup. You called it a high-alpha binary bet. Explain what high alpha actually means for a layman looking at this stock.
Sure. Alpha is a financial term used to describe an investment's ability to beat the market benchmark.
Okay.
If the S&P 500 goes up 10% and your stock goes up 10%, you have zero alpha. You just rode the wave.
You match the market.
A high alpha bet means there is a specific idiosyncratic catalyst within the company that could cause the stock to massively outperform the broader market, regardless of what the economy is doing.
So the thesis is, because the valuation is so compressed at 1.4 times revenue, you are buying a highly engaged, culturally massive social network at bargain bin multiples.
Yes. From an investment strategy standpoint, the core software business, if it is cleaned up, disciplined, and managed efficiently, as the activists are demanding, is deeply, fundamentally undervalued.
And what about the hardware?
The AR hardware division, the Spectacles project, is essentially a high-risk call option that is attached to the stock for free.
So if the glasses fail...
If the glasses fail, you still own a highly profitable, scaled social network, assuming management rationalizes their costs. But if the glasses actually succeed in 2026...
the upside potential is astronomical.
Exactly.
Which leaves us with the ultimate dilemma. And I want to pose this directly to you, the listener.
Think about this one.
When you look at the chaotic, fascinating landscape of Snap Inc., whose vision of the future do you actually buy into?
Yeah.
Do you invest your faith in Irenic Capital's spreadsheet? Do you vote for the ruthless, practical path of firing the dreamers, cutting the R&D costs, killing the sci-fi glasses, and driving the share price to $26 through sheer financial engineering and ad tech optimization?
Or do you invest in Evan Spiegel's 12-year, wildly expensive dream?
Do you accept the massive cash burn, the painful dilution, and the short-term market punishment because you believe he is one of the very few founders left in Silicon Valley who is actually willing to risk absolutely everything to invent a new competing paradigm and slay the smartphone?
It is the ultimate high-stakes clash between Wall Street pragmatism and Silicon Valley idealism.
It really is the defining conflict of the modern tech era. And as we wrap up this deep dive into the crucible moment of Snap, I want to leave you with one final, slightly terrifying thought that connects everything we've unpacked today.
Lay it on me.
We talked about Evan Spiegel's fear that software has no moat.
Right.
And we talked about how his own company just proved that AI can overnight generate 65% of the complex code needed to run a global app.
Yeah.
If those two things are true, doesn't that mean the era of the software monopoly is permanently over?
That's a scary thought.
And if software is fully commoditized to the point where anyone can build an app for free using AI, won't every major tech company eventually be forced to become a hardware company just to survive?
Now, that is a thought that will keep every software executive in Silicon Valley staring at the ceiling tonight.
Risk defined, portfolio protected.